Welcome and thank you for joining us today in this live virtual discussion of the 2021 Medium-Term Budget Policy Statement Economic Review. We'll be discussing the outcomes of yesterday's policy statement by the Finance Minister. The good news, a market-friendly statement that was comparatively better than last year's. A very strong fiscal consolidation message coming through, in addition to a strong statement on the need for economic policy reform to attain higher growth. On the cautionary side of things, there are macroeconomic expenditure risks that lie ahead that we will get into a bit later. My name is Saneliso Kanjo, and I will be your host. I'm joined by Johann Els, Chief Economist at the Old Mutual Investment Group. And before I hand over to Johann, just a few notes. The presentation will be about 30 minutes, leaving about 15 minutes to answer any questions. You can ask questions at any stage by entering them into the functionality on your right-hand side. We welcome your feedback. Please listen and engage with us right through to the end. We'd appreciate your written feedback in a short form we have prepared for you. I'll now hand over to the Chief Economist, Johann Els, and welcome, Johann.
Thanks very much, Saneliso. Welcome, everyone. It is a great opportunity to chat about the fiscal situation again, especially after we had the July unrests and then, of course, the local government elections. And during that process, people started getting worried about the possibility of a jump to the left in terms of fiscal policy. So I was pleasantly surprised by the new Minister of Finance's interaction with us, with the markets, with analysts, and his statement was very strong, I believe. So let's look at some of the detail and suddenly see where I hope everybody can see my slides. The minister absolutely stuck to the fiscal consolidation plans that we've had in the past. And I dare say that as he perhaps even strengthened that message through various comments throughout the budget documents and in his speech, it was a very market-friendly statement. So as I said in the intro, yeah, many people thought that, hang on, maybe the July unrest and the recent local government election outcome might mean a jump to the left, significant more social spending, using up all the extra revenue that we got this year for extra spending. That was not the case. And one of the comments, and I've got a few of these direct quotes from the minister in this presentation, he said, the unflinching commitment to fiscal sustainability. So a very strong statement on that. So I think markets did like it yesterday, will continue to like the message from this, the very strong emphasis on fiscal consolidation, no jump to the left, absolute commitment to policy reform. One of the quotes at the bottom again, equally important is the faster implementation of structural reforms. Now, all of this is in line with what I've come to know the minister as a very pragmatic policymaker for many years within the ANC's policy department, very pragmatic, pushing back on all the leftist type ideas, this unaffordable ideas that has been coming through up to the ANC into government. So that commitment is very strong. Said there's no extra money for state-owned enterprises, and where some people thought that, hang on, there might be extra money for Eskom or SAA, all the usual suspects. There was a strong statement, no extra money. For now, there's also no extra spending for social grants. The statement said the extension of social grants that we got after the July unrest will stop at the end of March. But there's a rider there, there's a potential extension there if we see further improvements in revenue compared to what they expected now. And we'll talk more about that component. They strong commitment again on the containment of wage bill growth. Again, that's another risk for me, but for now the statement there, the statement of intent to contain spending, and where wage bill is one of the biggest spending components. No tax increases, either in a statement or when I look through the numbers in terms of expectations for future growth of the main tax components. So obviously there might be some excise tax increases or fuel levy increases, but in terms of an overall big increase in tax or new taxes, nothing like that. So the deficit path going lower, the primary surplus by 2024, 2025, and the debt stabilization issue, all of those are very positive. And I think markets and ratings agencies will actually love the message coming from this. And for a few times, I've been highlighting the fact that the minister has said before he was minister and since he became Minister of Finance that there are better ways than social grants or basic income grants to support the poor, and that's by getting economic growth going. And he said again, a quote at the bottom here, let me reiterate that a permanent solution is to achieve high and sustained levels of economic growth. He's against spending more, especially when expenditure is driven out by big payments on debt servicing or the interest payments on government debt. So he wants faster structural reforms. He wants higher sustained economic growth to sort out all these problems. Now, we know that that takes some time, but at least we've started on that road, and a very positive market-friendly statement. A couple of other comments in terms of the fiscal consolidation. Stabilizing the debt burden is essential. Acknowledging that reforms remain slow, and keeping fiscal consolidation on course. The need to reduce the borrowing requirement. Targeted at short-term support for people and businesses. They don't want long-term support. So after the July unrest, COVID-19, all of those are intended to be short-term support because there's no room in the budget for long-term, medium or long-term support for that to continue. And that disciplined approach. So lots of wording in the budget documents, in the minister's speech, along the lines of the need for fiscal consolidation, the need for discipline in the fiscal position, and shifting away from short-term consumption towards the growth-enhancing investment. And that's a message that the minister, previous ministers, the president has given over and over and over the last few years. The need to involve the private sector to become involved in enhancing investment. So realizing that, yes, they will have to do their part once the short-term consumption spending issues is out of the window, and then they need to do their part, but they need to involve the private sector. That also came through in terms of the support for state-owned enterprises. They haven't got the money to do that. They want the private sector to become involved. And the reform issues, a couple of pointers that the minister mentioned yesterday, the energy generation. There was nothing new in terms of that, but the continued rolling out of the private sector involvement, self-generation, all of those issues coming to the fore. And I've seen in the press there's lots of negative comments around the fact that there wasn't more spending coming through in terms of electricity. I don't view that as something that would have been helpful. These things are taking a long time before we get new capacity, and it's been in the pipeline already. And I view it as a positive that they're not spending more, not throwing more money at the problem, because there are already processes in place. I'm saying that the broadband spectrum auction will start in March next year. Third-party access to the rail network, the long-delayed e-visa system, issues around skilled migration and infrastructure investment. So all of the known reforms in the system, but highlighting those again and pushing and getting some acceleration in terms of those. And one of the risk statements within the documents and within the medium-term budget was that the delaying of structural reform is a significant risk, apart from all the other usual risks that the highlight spending risks, etc. So in terms of a broader summary message, the fiscal consolidation, policy reform, smaller deficit path. In fact, the numbers have surprised on the upside. We're getting a primary surplus by 2024, 2025. Really, that was the point over the last few years, to get the budget to a position of a primary surplus. Extra revenue this year, conservatively, my wording, estimated at 120 billion rand. It could be significantly more as we roll through the next few months of this fiscal year. No tax increases, And then a very conservative approach to this revenue windfall and future spending in terms of the forecasts that we've seen, the efforts to contain the wage bill. But then there was an uplift in the expenditure ceiling. So that even though they say they're using the extra revenue to reduce the deficit over time, they did use it for some extra spending. Not necessarily a bad thing because that helps the economy, but something that we need to watch. And again, the risk from the spending side from that point to the wage bill limitations, the very low growth in the wage bill, that's a risk because will they be able to attain that? And that's the same risk we talked about last year and the year before when Minister Mboweni at that time also wanted to limit the size of the wage bill. It's difficult. It's not always easy. So there are risks around that. And there was nothing new on social grants or basic income grant, but it seems that they're readying the message that between now and February, some kind of decision will be made to maybe extend the grant, to maybe have some new kind of unemployment grant. I doubt it very much still that we'll get a basic income grant. The message was very clear, though, that if we cannot afford it, we cannot do it. But the message was also there, if there's further than the 120 billion rand uplift in revenue, that actually might happen. So I think the message here was very strong, very market friendly, perhaps a stronger statement even than what many people expected in terms of this need to get the fiscal consolidation. And thus there was no jump to the left in terms of policy, absolutely continuing on the right path here. And that is a crucial, important message. So we've had a significant improvement over the past year. In October last year, the debt to GDP ratio was presented by that blue line. And that was a shocker, as we remember from last year. Very bad MTBPS. Markets didn't like it at all. I didn't like it at all. And then by February, when the realization came through that last year also had significant revenue overruns, that yellow line was the deficit path. And then now the green line at the bottom, what was presented now. And of course, a part of that is the adjustment in GDP, the uplift in nominal GDP helped that significantly. From last year when the deficit ratio was set to peak around 95% of GDP, it's now below 80% of GDP. But if I plug in, and many of you have heard my message that I believe reforms already in the pipeline can lead to stronger medium-term economic growth. My estimate is around 2.5% annual average growth over the next 5, 6, 7 years, compared to only 1% annual average growth over the 5 years to 2019. So that uplift in growth, so I've got slightly better growth than Treasury in the forecast, that means the deficit of the debt to GDP ratio can even look slightly better, my black line there at the bottom, so that we, within the next year or 2, 3, can actually peak and then start easing off. So the result of fiscal consolidation within the budget leading towards a primary surplus within the next few years, better medium-term growth, the debt to GDP ratio can look significantly better than this time last year. And that's the significant reduction in fiscal risk. Now that means, yes, the risk has declined significantly, but we're not out of the woods. I highlighted some of the expenditure risks. So we need to stick to this path, and that's the strong message here. We shouldn't be complacent now and using that, and they're not doing that, but I'm reiterating that message, that complacency is a big risk. So in terms of the growth assumptions, excuse me, Treasury has got the real GDP growth this year of 5.1% versus my 5.6%. Next year, they've got 1.8, and 2023, 1.6. So I view that as very conservative forecasts. So that takes some risk out of the budget because I believe growth can actually be slightly higher. Even if I'm wrong with 2.3 and 2.5 in 2022 and 2023, closer to 2% would be my estimate if I'm wrong on 2.3 and 2.5. So slightly even better than Treasury. So conservative forecasting, that's a positive in my mind. So revenue, the outcome much better than the February budget. As I said, they've got 120 billion rand extra. Now, eventually it could be 160 to 180 billion because there's some conservative assumptions in these numbers and there's still a few months left of this fiscal year. So I think that some of these components can show us better numbers. And that's that better numbers where they highlighted later on that if it's bigger than 120, they can use some of that for extra social grant relief. But as you can see, a big part of that came from corporate income taxes, and that's the commodity price uplift that helped mining profit significantly. But also very conservatively and prudently, they realized that this effect is temporary because that commodity price uplift isn't going to last. And they say revenue collections remain well below the pre-pandemic expectations. So what they expected back in late 2019, early 2020, before the impact of the pandemic came through. So I think very prudent numbers here. And that's important. Plus, in terms of their forecasts over the next few years, remember the MTBPS is a medium-term expenditure framework where they put their forecast for the next 3 years for both revenue and expenditure into the numbers. And if you look at the forecast for personal income tax over the next few years, the same for corporate income tax, value-added tax, custom duties, fuel levy, etc. Those are very conservative forecasts versus even their low growth expectations. So not overly optimistic means that it would likely be easier to attain their growth forecast. You would see the downshift, minus 21% growth in corporate income tax next year. That's the assumption that commodity prices aren't staying where they are, that mining profits will come off, and therefore taxes on the mining side will especially be coming off. So very prudent forecasts here. And while I said MTBPS isn't usually the forum to announce tax increases, from the assumptions here in the growth numbers, it doesn't look like there's any new taxes or tax increases, except for maybe some taxes and fuel levy that we haven't seen yet. So on the expenditure side, a couple of important comments there. Continued expenditure control remains a huge priority. Government, as I said at the start, no extra spending for SOE, specifically saying they will avoid permanent increases in departmental or program baselines. So even a social grant extension would likely be temporary because they don't want a permanent uplift in any program that could include social grants or SOEs or further bailouts. And short-term tax windfalls will be targeted to reduce the budget deficit, fund temporary priorities, such as extended support for poor households and public employment. So temporary issues, highlighting specifically that apart from the expenditure control that they need to keep, they don't want permanent uplifts in any program or expenditure line. So for now, as I said, no extension of the COVID grant after March 2022, but if there's a significant further uplift in revenue, if it turns out to be 160 or 180 billion versus the expectation of 120, which it easily could, then there might be a temporary increase in social grants or extension of social grants rather. I still don't expect the basic income grant. The minister's emphasis on rather getting policy reform to attain higher sustained economic growth, to make inroads into that poverty and unemployment rather than a grant. That is a pretty strong statement. So I believe that Treasury and the Minister will push back against permanent increases. And the very low wage bill growth assumed in the medium-term budgets, that's also a risk because will they be able to attain those targets given union pushback on those? So risks around the expenditure, even though the intent seems very clear that they're going to try and maintain that. Now, this is basically history, but there has been extra spending in the current fiscal year. The support around the July unrests, other increases coming through, etc. So in terms of non-interest spending, an extra almost 60 billion rand there. But also in terms of when we look at the consolidated budget, not just the main budget, and as you know, the consolidated budget includes municipalities and provincial governments, but also crucially, social security funds like the unemployment insurance fund, and the UIF, for instance, also had extra spending. So if you look at the total uplift, expenditure was up by more than 100 billion as well. That doesn't sit well with me. There were some specific reasons. Yes, there was extra revenue that could finance that. I'm worried about the trend here. So the intent, the message is positive, but we need to keep a close eye on expenditure. There are clear risks. Total spending growth over the next few years only are going to average 1.8% per year. That's very low. You can see the risk there. Wage bill growth within that total spending only growing by 1% per year on average over the next 3 years. And social grant spending is expected to decline next year as of course, these extensions, these COVID grants, these extra grants come to an end. But there's some decisions around that that will still come through. So in terms of the social security system, the statement was there. So the negative that it might continue, but there's some pushback from Treasury and the Minister. They say it must be fully and appropriately financed because they don't want the fiscal balance to deteriorate. So if there's extra spending, if there's extra revenue coming through above what they assume now, then I think there will be an extra social grant. But if not, and if we can't afford it, and if it impacts negatively on the fiscal balance, then they won't do it. Also very clear in a couple of comments that it needs to be evaluated against pre-existing priorities, other things like basic services, etc. Realizing that they can't keep on giving money through social grants when there are other urgent needs on the budget for expenditure. So if the situation improves, if it doesn't crowd out other spending, then there's perhaps a little bit of room for additional social relief. But it's clear the decision hasn't been made, but there's the risk. Fortunately, against the risk, there's this statement that it needs to be financed, it needs to be weighed up against other spending priorities. And then, as I said, the public sector wage bill, a clear intent there as well that costs need to be contained, saying that, you know, if there's no new agreement, that 1,000 Rand after tax cash gratuity that they paid this year will continue. And they've included that in the budget provisionally for next year. So again, prudent that they included it, but it doesn't look like there's any other wage increases included apart from the notch uplift of 1.5%. And they're clearly highlighting the risk still that case in front of the Constitutional Court, the 2018 final wage agreement, they need to find extra revenue if the court forces them to pay that. So again, clear statement that they're acknowledging the risk, but they're saying the need for fiscal consolidation has ended that trend of above inflation growth in the wage bill. So yes, Minister Mboweni, as the previous Minister of Finance, was very strong on that. This minister and the same Treasury very strong on that message again. So it's clear to me that it's a government message. It should have the broad support of Cabinet. And as I said, only 1.5% growth included next year for the public sector wage bill. So not a lot of economic support from that, but clear, very positive in terms of the budget, in terms of the fiscal position. Now, of course, as one would expect, the minister made a lot of this point, what they call the social wage. So it's not only the type of community development, but it's also education, it's also health, it's also the free higher education and training, it's the social protection and other social security funds. So making a big point that, hang on, we already spend a lot on the social issues, and as I said, they call it the social wage. In this fiscal year, it's 60% of non-interest spending is on the social wage. It doesn't decline a lot, it stays around 59.5% over the next few years. So pushing back on the argument that we need a basic income grant, pushing back on the argument that we need more social spending, etc., that we're already spending a lot. And yes, it does have to include basic education and health and free higher education. That's spending on the social environment. So a very strong statement there, pushing back on the need for other social spending because we're already spending a lot on these. Just briefly in terms of the numbers, for those of you who want to see the numbers, as I said, extra revenue, not only tax revenue, but some other revenue coming through. Some of the mining royalties doesn't sit in the tax component that I showed earlier. So revenue up by 128 billion, the estimate now versus the February budget in this current fiscal year, but expenditure up a whopping 108 billion as well. And that was bigger than I expected. But a big part of that sitting within the UIF and the other social security funds. So the balance, budget balance reduced by 20 billion. Of course, the other benefit is that GDP was uplifted. In any case, moving in the right direction, clearly, even with the new uplifted GDP numbers, the higher base, last year's deficit was 10%. We're moving towards 5% by 2023, 2024. And crucially, the primary balance, when we exclude interest payments, we're moving from 8% last year to minus 0.3% in 2023-24, and the next year a slight surplus. And that is positive, that we're moving from a big deficit, excluding interest payments, to a surplus by 2024, 2025. So apart from all the strong messages around fiscal consolidation, around policy reform, around the need for permanent uplift in economic growth, this clear message that we need to continue on this path going forward. And further numbers here, a couple of things that I want to highlight, and suddenly see where I'm sure this presentation will eventually be shared amongst participants in a PDF form or whatever. So then you can look at this in your own time. But in the column on the right-hand side there, I have average growth over the next 3 years. In total expenditures, 1.8%, a number that we showed earlier. Interest costs, of course, that's the huge one that's crowding out other spending. In fact, that more than 300 billion per year that we're spending over the next few years, we can have VAT rate at 0. We can build significant houses. We can slash Eskom's debt. So lots of things that crowds out. But that growth on average over the next 3 years is 10.8%. Wage bill growth only 1%, social grants and a slight negative number there. So you can see that very low expenditure growth in all areas except for interest costs. So if we attain that, absolutely fantastic. But that's where the risk lies in my mind around these expenditure growth issues. So the intent is clear, the intent is positive, the message is fantastic, but there are risks around the expenditure components. I wanted to just briefly touch on a few other areas. In terms of the economy, it's clear to me that we need to move on from this argument of economic stagnation, the COVID impact. We're heading into a period of a much more sustainable fiscal path, thanks to much better growth as well. The global environment is still supportive. There are issues, risks around global supply chain issues, around the energy crunch, inflation, etc. I believe lots of those issues, the oil price rise, the supply chain issues, could potentially have a more negative impact on growth rather than inflation. None of those, in my mind, will be inflationary. In other words, leading to other price increases on a sustained basis. I think inflation will fall back next year. I think policymakers are worried about the negative impact from these issues on business spending, on consumer spending. And therefore, the Fed's start of tapering, the start of interest rates and the pace of tapering might be impacted by the acknowledgement of the risks around those issues into growth. In South Africa, better growth, better budget, inflation contained low. Yes, interest rates will have to go up, but at a slow pace and maybe only from next year. And a more stable rand over the medium term. Just briefly, a couple of indicators. the downswing in global growth has returned or turned up recently again after that Delta variant impact on the PMIs, global PMIs, Purchasing Managers Indices, both the services sector and the manufacturing sector ticking up in the latest number. And in any case, despite the downswing around the middle months of this year, has been in expansionary territory, in other words, above 50. Lots of interest rate increases in emerging economies because the inflation numbers are higher. And the crucial point here is that despite Turkey's inflation being high, Turkey cut rates because the president fired some of the central bank deputy governors and MPC members. Now, even during the Zuma years, we never had an issue like that. So South Africa still stands out amongst some of these emerging economies. So looking much better fundamentally than some of those emerging economies. Locally, I expect 5.6% growth this year, support from the inventory cycle, support from consumers, from private sector investment, and still some decent support from exports. Not to the extent that we had it earlier this year, and easing off into next year. The commodity prices won't stay that high, but still some support from that. And the July unrest impact, you can see it through car sales, through manufacturing production, through retail sales, but those have recovered to a large extent, not fully, but to some extent. PMIs have recovered from July, starting to slip again. It looks like the third quarter GDP number could be 0 to slightly negative, but a rebound is expected in the fourth quarter. So I'm happy with my 5.6% growth forecast for this year. Inflation well under control, core inflation the bottom end of the target range, headline inflation more impacted by base effects from COVID, lockdown, unlocking the economy, etc. And headline inflation will likely remain around 5% over the next couple of months due to petrol price increases, but services inflation very low, and that will keep headline inflation under control. I expect mostly around 4.5% over the medium term, which is a space where the Reserve Bank should be fairly happy with inflation. And in terms of food inflation, we've seen some pipeline price pressures easing off quite a bit. Grain and meat from the farm to the factory to consumer prices, food inflation busy easing. And consumer goods inflation numbers well contained on a year-on-year basis on the left, and on a shorter term 3-month rolling annualized rate of change on the right, easing off again recently. So there's no demand pull inflation in this economy. And therefore, I think that the Reserve Bank in November will likely keep rates unchanged again. Maybe not a unanimous vote as it was in the September meeting. I think they will only start hiking rates early next year. And even then, it'll be a slow upward path. So much so that by the end of 2023, I believe we'll still be below the level of policy rate that we had at the start of 2020. In other words, before the COVID crisis. So a slow upward path in interest rates, not too detrimental to economic growth. Medium-term growth, we're going to turn around that downward path to a slight upward path from 1% annual average growth in the 5 years to 2019 to 2.5% annual average growth over the medium term. It's not what we need. It's far below the 4 to 5 that we need, but it's more than double what we had, and it will make some improvements. So we've come from lots of tailwinds holding us back to those tailwinds dying down and some of the headwinds starting to pick up. From political and policy uncertainty to a far improved environment there. Commodity prices, interest rates helping, from drought to record crops. Yes, load shedding still, but massive energy investment will help reduce the load shedding risk down the line. It's not an overnight fix, not tonight, not tomorrow, not next month, but by this time next year into 2023, the risk should be significantly reduced. And COVID is behind us. There might be a fourth wave. It will be far reduced in intensity, and my base case is by April, May next year, the state of disaster will be a thing of the past, and that COVID will be managed similar to a flu. I've shown you this slide many times before. Lots of improvement in policy. We've had significant strength in the messaging around some of these issues in the MTBPS. Yes, to get to 4% or more on a sustained basis, we need significantly more. Significant privatization, substantial labor market deregulation, education reform, etc. It's unlikely that this will happen in the way and format that we need or want to see, but some privatization by stealth is happening within the state-owned enterprises. Private sector involvement in energy generation, in ports, in Transnet's other areas of expertise. So gradually we're building on this. For now, 2.5% medium-term growth. These things aren't happening seriously enough to say anything higher than that. But we have turned the corner in terms of coming from a downtrend to stabilizing to heading into an uptrend. And there's lots of existing strengths that foreign investors will look at. The rule of law doesn't matter at all that the previous president is now at home and not in jail anymore. It's the principle that was established in the strong institutions, the fact that our presidents, whoever they were or have been in the past, can't fire or didn't fire central bank MPC members. Those things are hugely important and things that foreign investors watch. And I'm sure you're busy casting your eye down that list as I speak. There are lots of other very strong positives. And with this budget, this MTBPS being substantially market friendly and positive, gradually all these will head into pushing confidence significantly higher. That will drive growth. So the downtrend has come to an end, and I strongly believe that we're heading into an upward phase going forward. So Lucy, let me stop there and let's take the rest of the time for questions. Thank you very much.
Thank you for those insights, Johann. I think in summary, a balanced maiden policy statement by the minister, market friendly. Some key points I think worth emphasizing is that significant risks include delaying structural reforms, apart from the general risks that come with tabling such a budget. And while the act of forecasting is never easy, conservative growth forecasts are a positive and there is no room for complacency. Questions have come through, Johann, warmed up during this morning. Question for Mark Anderson, and I think just hinging from the global side of things, in that the domestic economy is affected by global happenings. What are your views on tapering and interest rate increases in the US having a negative impact on our equity market?
Yes, good question. I don't think this time around we're seeing the tapering tantrum that we had in the previous cycle. I think it's been well signaled by the Fed that tapering is coming. Tapering will, in my mind, likely continue at the pace they announced from November and December, but there are risks, the supply chain risk, the energy price risks, that the Fed is worried about that might impact on consumer and business spending, so a negative for economic growth potentially. So I think the fact that they left open the pace of tapering from January onwards means that they're aware of those risks. So it is possible that tapering can slow, the pace of cutting back on QE can slow as the Fed continues to watch this. But let's assume for now that tapering continues at $15 billion per month, then it will end, in other words, QE will come to an end by June next year. I think the Fed has made it very clear also that the bar for hiking interest rates is far higher than starting tapering. So I think interest rates sometime in 2023, maybe that's been brought forward already from the end of 2023 into earlier, maybe even into the first half of 2023. The Fed is still very clear, and I believe that inflation is a year-on-year calculation, so we're creating high base effects now, and next year inflation will start to decline. I don't fear inflation. I fear the negative impact on economic growth coming from those factors that's driving short-term inflation prices. Plus, I would rather fear interest rate increases, because if and when the Fed starts believing that inflation might become entrenched and permanent, then the Fed will hike rates sooner than what we think. I don't think we're there. What I'm saying is that instead of fearing high inflation down the line, I would rather think it will not happen because the Fed will hike rates quicker and faster and thus stop inflation. So watch the Fed's messaging.
Thank you for that answer, Johann. And I think it's a good place to leave it. It's a good place to leave the first tabling of the policy statement. You know, gearing up to February next year by the finance minister. Unfortunately, that's all the time we have for today. Thank you for listening, and please don't forget to share your valued feedback. From Johann, myself, Sanedisoe, and the team, it's goodbye for now.